Have you ever experienced this frustrating scenario? You carefully set your support line, you establish a resistance line, and you patiently wait for the market to break out. Finally, the price surges past your resistance, and filled with excitement, you jump into the trade, convinced you're about to ride a massive wave of profit. You settle in, maybe even grab some popcorn, and watch the charts expecting a big move. But then, out of nowhere, the price reverses. It doesn't just stall, it dips, leaving you staring at the screen in disbelief. Your excitement turns to confusion as you realize your portfolio has just taken a hit. Sound familiar? If it does, don't worry, you're not alone. But here's the good news. There's a secret to avoid this exact situation from ever happening again. And in this video, I'm going to share it with you. Trust me, after this, you'll never look at breakouts the same way again. The first important question we need to consider is, what exactly is a breakout? Understanding this concept is essential if you want to master trading breakouts effectively. A breakout occurs when you have established both support and resistance levels on your chart. These are key price points where the market has tested multiple times but failed to move beyond. The price bounces off these levels, creating rejections at both support and resistance, signaling a kind of balance or consolidation. However, the breakout itself happens when the price finally manages to break through one of these key levels, either pushing above the resistance or falling below the support, often with significant momentum. This is the moment traders watch for because it signals a potential shift in market direction. But how do you trade it successfully? Stick around because we're about to dive deeper into how to capitalize on this powerful move. Now, take note of what typically happens when the price finally breaks through a key level. It doesn't just move, it often starts to soar. This creates an ideal entry point for traders, right at the moment the price bursts through the resistance or falls below the support. But here's the real challenge. How do we consistently find these setups where the market shows the potential for a breakout before it actually happens? The key lies in recognizing breakout patterns. These patterns can help you spot when a breakout is likely to occur, allowing you to position yourself for maximum profit before the market makes its move. In the rest of this video, we'll explore these patterns in detail, giving you the tools to confidently identify and trade breakouts like a pro. I'm sure most of you have seen these before, but when it comes to trading breakouts, there are several key patterns you should always keep in mind. These include the wedge, flag, rectangle, triangle, and pennant. Each of these patterns can signal an upcoming breakout, but here's where many traders go wrong. They expect the price action to match the exact pattern they see in textbook images or charts. The reality is, the market almost never follows the perfect shape of those idealized patterns. So instead of waiting for an exact replica of a pattern, your focus should be on identifying the key support and resistance levels that form the pattern. It's these levels that give you the signal to anticipate a breakout, not the precise appearance of the price action. In this video, we'll break down each of these patterns, show you how to recognize them in real market conditions, and most importantly, how to trade them effectively. Let's be honest for a moment, it really doesn't matter which specific pattern you spot on the chart. In fact, you don't even need to memorize the names of all the breakout patterns. What's truly important, and what you must take away from this, is that all of these patterns share one crucial element: price consolidation. Every breakout pattern involves the price moving within two key levels, support and resistance, before it eventually breaks out. That's the core principle. For example, when we observe price movement that forms multiple key points of support and resistance, the more points we can identify, the stronger the pattern becomes. In this scenario, we recognize the setup and draw our support and resistance lines, which in this case forms a rectangle pattern. The focus isn't on the name of the pattern, but on understanding the consolidation and preparing for the breakout. Stick with me, and I'll show you exactly how to use this knowledge to sharpen your trading strategy. So far, so good, but this is where many traders tend to make a critical mistake. What usually happens is that traders wait for a breakout in either direction. Fair enough. But the moment they see the price break through their resistance line, they rush to enter the trade, assuming the breakout is genuine. However, more often than they expect, it turns out to be a false breakout, and the price quickly reverses in the opposite direction. This kind of scenario can lead to significant losses, leaving traders frustrated and wondering what went wrong. But don't worry, because in this video I'm going to show you exactly how to avoid this common trap. I'll teach you the steps you need to take to increase the chances of the price moving in the direction you anticipate, ensuring you trade with much more confidence and precision. And let's make sure you don't fall victim to those false breakouts ever again. The first concept we need to grasp is something known as momentum candles. Momentum candles are essential in identifying the strength of a price movement during a potential breakout. These candles can appear in different forms, but there are two key types we should focus on. The first is a single large candle with a strong, full body, indicating a powerful price move in one direction. The second form involves a series of three medium-sized candles, all moving consistently in the same direction. These two types of momentum candles are exactly what we'll be watching for when trying to confirm a breakout. Spotting them can significantly improve your chances of success in trading. Let me show you a clear example of what these candles look like and how to use them to your advantage, because mastering this will take your trading strategy to the next level. In this example, we're looking at a chart where the price has formed a series of higher highs, allowing us to establish a clear resistance level at the top. At the same time, we identify a key support level at the bottom as the price has reversed at this point several times. Now we wait for the price to make its move. Soon, we see a decent-sized candle form and push through the resistance level. But here's the catch. Only the tip of the candle breaks above the resistance line, which means we can't count it as a true momentum candle. For it to qualify, the majority of the candle's body needs to break through the resistance. Alternatively, we could also count it if another green candle forms outside the resistance line, confirming the breakout. Unfortunately, in this case, the next candle is red, signaling a reversal instead. As a result, we ignore this signal, and just as we expected, it turns out to be a false breakout. This is a perfect example of why being patient and waiting for clear momentum is crucial to avoid falling into a losing trade. Let's dive deeper into how to avoid these traps and ensure your trades are based on solid signals. Let me walk you through another example. Here we've already set up our support and resistance levels, and the price begins to move. We see a decent-sized candle break through the resistance, but we don't act yet because it's not a momentum candle. It doesn't have a large enough body to confirm a strong breakout, so we wait for further confirmation. A second candle forms, but again it's relatively small, so we remain patient. As mentioned earlier, we're only looking for momentum candles that have a large body or a sequence of 3 consecutive green candles. We wait again, and then the third green candle finally appears, which is a very bullish sign. This is when we decide to enter the trade. Now from this point, there are 3 potential outcomes. The price might continue to rise steadily. It could also pull back, retesting the resistance level before bouncing off and moving higher. Or in the worst case, the price could fall back below the resistance, signaling that this was a false breakout. So what's the best course of action here? Should we wait for a pullback to confirm the breakout strength, or should we jump into the trade right now? Here's what I prefer to do. I set up a strategy that puts the odds in my favor, regardless of what the market does next. Instead of waiting for a potential pullback, I enter the trade right at the close of the momentum candle. This way, I position myself early, but with calculated risk. To manage that risk, I set my stop loss just below the resistance level. By doing this, if the price pulls back and retests the resistance before bouncing upward, it won't hit my stop loss and I'll still have the opportunity to profit. On the other hand, if the price continues to rise without pulling back, I'm already in the trade, ready to capture those gains. Given that this candle is a momentum candle, the chances of it being a false breakout are quite low. However, in the unlikely event that the breakout fails and the price reverses, I have my stop loss in place to protect my capital. Now that we've secured our entry point, the next step is to determine a solid exit strategy. When it comes to breakouts, they often present massive upside potential. If we were to stick with the standard 1.5 risk-to-reward ratio, we'd be leaving a lot of profit on the table. To ensure we capture these larger gains, I use what I call the two-step take-profit system. Here's how it works. First, after identifying our entry signal, we place the stop loss just below the resistance line. Then, we set our initial take-profit level at a 1.5 ratio. Once the price reaches this target, we sell half of our position to lock in a guaranteed profit. The remaining half stays active in the market, and now we adjust our stop loss to match the previous take-profit level. From there, we use an indicator, specifically the chandelier indicator, to set our next take-profit point. To make things easier for you, I've provided the chandelier indicator in the description box below this video. I've also included all the settings exactly as shown in this tutorial, so all you need to do is download it and apply it to your trading platform. The chandelier indicator will serve as our guide for the exit strategy. It's simple. After selling half of our position at the 1.5 ratio, we let the rest ride, with our stop loss now protecting those profits. We'll exit the trade once the chandelier indicator changes color. For example, in this case, we would have sold the remainder of our position at the indicator's signal. Notice how much extra profit we were able to capture by holding on to half of our shares. If we had sold everything at the 1.5 ratio, we would have missed out on a significant upside. You can also observe that the price surged straight up without a pullback. This is why I prefer to enter trades immediately, as many breakouts tend to move sharply in one direction without retracing. By using this strategy, we maximize both our profits and our trade efficiency. Let's walk through one final example. We start by identifying a few key points on the chart that serve as strong levels of support and resistance. Once we have these trend lines in place, we patiently wait for a momentum candle to break through the resistance. A candle does break through, but since its body isn't large enough, we hold off and wait for 2 additional green candles to confirm the breakout. After seeing the 3 green candles, we confidently enter the trade. Next, we place our stop loss just below the resistance line to protect against any sudden reversals. We then set our initial take profit level at a 1.5 risk to reward ratio. Now, it's a matter of waiting for the price to reach that target. Once it does, we sell half of our position to lock in some profits. After securing that first portion of the trade, we adjust our stop loss to the previous take profit mark, effectively safeguarding our gains. At this point, we activate the chandelier indicator to guide our next move. We allow the remaining portion of our trade to continue running, and we only exit when the chandelier indicator signals a trend reversal by changing colors. Once that happens, we sell the remaining half of our shares, capturing additional profits that we would have missed by exiting too early. In this video, I've shared some valuable secrets to enhance your breakout trading strategy. If you found this helpful, all I ask is that you take just 2 seconds to hit the like button. It really helps support the channel. And if you're eager to see part 2, where I'll show you even more ways to maximize the profitability of this strategy, be sure to check out the next video. Thanks for watching, and I'll catch you in the next one.